Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into Next Level Charting. Thank you very much for joining us. I appreciate it. If you're watching this video on YouTube, and you like it, of course, please give us a thumbs up and consider subscribing. So today we're going to start off with relative chart strength using benchmark lows. How can we see when something is outperforming on the charts? Then we'll show you how to pick a level to prove a signal wrong, because we got a number of short-term breakouts that we're watching here at Trend Investor Pro. And finally, I'm going to show you how I would use ATR trailing stops for a trend following strategy. So today we're going to show you a little bit from Thursday's commentary here at TrendInvestorPro.com. This is the main analysis page, and update the market regime every week. Are we in a bull market or a bear market? I have the ETF signal table, which we're going to show in a little bit, and then all the latest articles. And today we're going to look at the article. We're going to look at benchmark lows in particular and how to show or how to find relative chart strength by comparing lows against the benchmark. And then we're going to show how to use the ATR trailing stop in a trend following strategy. So first and foremost, the market regime is currently bearish, and it has been bearish since April 11th. That's when the composite breadth model turned negative. And so looking at the charts, I'm being very skeptical in what I see, or very choosy, because picking winners in a bear market is a challenge. Now we're seeing some ETFs that are showing relative strength when we compare the lows in the S&P 500 SPDR with the lows in the ETF. And this is benchmark lows to basically measure relative chart performance. And so I got two examples here. The first one is SPY and the agribusiness ETF, MOO. And we can see here that SPY has a lower low there from January to February and into March. And then if we look down at MOO, we can see that it's got a higher low. So it's outperforming by the fact that it is forming that higher low. In other words, selling pressure wasn't strong enough to push it to a lower low like it did in SPY. And that was kind of the tell before we got this breakout and market leading advance. And then if we go forward here in April, we can see SPY breaking below the March low there. Whereas we look at MOO on the bottom, it is holding that February low. There's the February-March low support zone, and it's holding this zone in MOO. So that's a sign of relative strength. We didn't get a lower low there. And then if we look short-term here in May, we look at SPY and we can see a lower low. We have a double dip in May from early May to late May, a lower low. And we look at MOO and it's got a higher low. So this one is showing relative strength, and of the few stock-based ETFs that I want on my radar as potential longs, this would be one of them. The next one is healthcare, XLV, and it is showing some relative chart strength here. If we look at these February-March lows in SPY, again, lower lows, and then we look at the February-March lows in XLV, we have a higher low, and then that breakout. And here we have a 52-week high in April, whereas SPY did not get close to its 52-week high. So that shows relative strength as well. And then XLV came all the way down. It did break the February low on a closing basis. But if we look short-term here in May, we've got a higher low in XLV. So we're seeing that we got some selling pressure in the middle of May, but it didn't push it below that prior low. Selling pressure wasn't that strong compared to SPY, where you had selling pressure pushing it to a lower low. Now, technically, SPY is oversold and could get a bounce within a bigger downtrend, but it is considered a counter-trend bounce. Now, I want to look at the trend for XLV in particular next, because it has lost some of its uptrend consistency and persistency. So here is XLV, and we can see that it's getting 52-week highs here in September, in December, and in April. So 52-week highs, higher highs, that's part of an uptrend. And you would expect higher lows to also be part of an uptrend, to be consistent and persistent. But you can see we have this move to the September-October low and a 52-week high. And then we have a test of that low after the 52-week high. And then we get another 52-week high, and we have another test of that low. So what we've got here is a bit of inconsistency in this uptrend by the fact that these pullbacks have been deep enough to test that support zone in the 125 area in February, January, February, and again in May. So that's when I say XLV has lost a bit of its uptrend consistency and persistency. But when we look at XLV, we can see that there is a sharp pullback and a breakout working. So it's showing a little bit of relative strength. I showed the higher low on the previous chart relative to SPY. So we've got a breakout here. And so when we have a breakout and we have a bullish signal, our job is to determine what is it going to take to prove that signal otherwise wrong. And so that's what I'm looking for now. What could make me wrong on this trade? And so the trade is the breakout. It's bullish. So we have an upswing working here. What could make it wrong is this could be a rising wedge, the dotted blue lines there. So you have a sharp decline and you have a potential rising wedge. And if you break down here, that's going to be a short-term bearish signal that would likely lead to a break below 125 and a move below the fall and winter lows. Now, that hasn't happened yet, but we need to be vigilant on what it would take to prove our stance otherwise. And I would suggest it would be a move below this lower trend line. We'll call it 127. You go below, close below 127, that would argue for a reevaluation on this upswing here. And I've also got similar reevaluations for upswings that we've identified in MOO and also XME, the metals and mining ETF. And that's further in this report available to subscribers. So if you're on Trend Investor Pro and you're on the analysis page, if you click the free analysis link there, you will be taken to analysis that is available for everybody. I've got an article on Monday on the base metals ETF, which we're going to look at next year. And I've also got a Trend Composite signal table for the S&P 500 stocks, and that is updated every Saturday morning. And there you can see the new trend signals within the S&P 500. You just click that recent signals link, and you'll see we got one new uptrend and a bunch of new downtrends over the past week. And over on the right, you can click to see a sharp chart. So I'm going to look at the chart for DBB here now. And what we've got is we've got a trend that lost a bit of its consistency because, you know, you expect after a move to new highs that you're going to get a pullback. That's okay. And we got what would look like a consolidation here, but it turned into a rout. We had an 18% decline. But you can see we're holding above support here from the November-December lows, and the trend composite stayed positive there. So we still got an uptrend. And then we look at the downswing, and we can see we've got a breakout here. We've got a break above that steep trend line and a break above that high right there. So that is bullish. And at this point, we have to decide what is it going to take to prove this reversal breakout otherwise. And I'm using an ATR Trailing Stop here, and that's part of the Trend Investor Pro Indicator Edge plugin. I'll show you next when I use the Trend Composite. But it's basically two ATR 22 values below the highest close since the breakout. So it starts right here below this low, and you can see as prices move higher, it moves up, and it's currently at 2208. So adding a buffer, I would say if we close below 22, that is going to negate that setup, that breakout, and call for a reevaluation. Because remember, our job is to identify setups, to identify the signals, take the signals, and then set that level that will prove that signal wrong. Sure, there's going to be some hit and miss, and you're going to have some whipsaws, but we have to have some sort of a process and some sort of a strategy. We can't just wing it every time. And especially, I think it's very dangerous to make changes to your plan during the market when prices are moving and reacting to the volatility that is out there. You have to set your plan before you make the trade, and you have to trade according to that plan once the trade is ongoing. Sure, you can make adjustments. Personally, I only make adjustments after the close. When things are not moving, I can look at a still chart and make decisions without the noise out there. So I've got to close below 22 saying reevaluate and put in a stop loss because that could be a failure on the breakout. So now we're going to go to StockCharts ACP and show you the Trend Composite in action along with the ATR Trailing Stop. And this is the iShares Latin America 40 ETF ILF, big weighting in Brazil in this ETF. And I want to show you a previous signal first before we look at the current signal. So the previous signal here, you see the Trend Composite turning positive right there. And so you have a little pullback and then a move to new highs. So when the Trend Composite turns positive, that's a bullish signal, a buy signal if you're inclined to take it. And then you have to decide on what your exit is. And there are two possible exits as far as my strategy is concerned. Either when the Trend Composite turns negative or when the ATR Trailing Stop is hit. Now this ATR Trailing Stop is set 6 ATR 22 values below the highest close. So you can see when prices rise, this ATR Trailing Stop rises because the highest close is rising. And when prices flatline or move down, that Trailing Stop flatlines. And there you can see it triggered on April 22nd. And the Trend Composite was still positive. So there are two possible exits, either when the Trend Composite turns negative, which it did near the low in May, or when you hit the ATR Trailing Stop. Now, if we flash forward, we can see we've got a bullish signal here on May 17th with the ILF and the Trend Composite turning positive. And I've got two ATR Trailing Stops. One is 2 ATR 22 values below the highest close, and it's tight, 26.43. Chances of whipsaw are above average because it's a tight stop. And this is probably more for swing traders, shorter term traders. Now, if you're a trend follower and you want to give a little wiggle room, you would be using a wider stop. So this one is 6 ATR values below the highest close, and it's at 23.55. This is similar to the stop here. Now, in order for this stop to work, we're going to have to move significantly higher to get that stop up. But right now, as far as the exit is concerned, there are two possibilities in this strategy. Either when the Trend Composite turns negative or when the ATR Trailing Stop is hit. And so I would imagine that if we move down below 26, that could turn the Trend Composite negative again, and that would be an exit. So you wouldn't have to wait for a move all the way below 23.55. So that is something to consider. Are you a swing trader? Are you a trend follower? How tight do you want your stops? And what is your overall strategy? Because everybody has their own personal preferences, and it's up for you to decide what those are. So if you'd like to know more about trendinvestorpro.com, you can click on the link below in the description. Again, if you like this video, please give us a thumbs up and consider subscribing to StockCharts. Thanks again for tuning in. Have a great day, and I'll talk to you again next week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.